Hi. Let's learn about 412(I) plan, what it means, how it works. A 412 plan was a defined benefit pension plan that was designed for small business owners in the U.S. It was classified as a tax-qualified pension plan, so any amount that the owner contributed to it could immediately be taken as a tax deduction by the company. Guaranteed annuities or a combination of annuities and life insurance were the only things that could fund a 412(I) plan. The 412(I) plan was replaced by the 412(E)(3) plan after December 31, 2007. Notably, 412 plans were developed for small business owners who often found it difficult to invest in their company while trying to save for employees' retirement. The 412(I) plan was unique in that it provided fully guaranteed retirement benefits. An insurance company had to sponsor the 412(I) plan, and only insurance products like annuities and life insurance policies could fund it. Contributions to it provide the largest tax deduction possible. An annuity is a financial product that an individual can purchase via a lump sum payment or installments. The insurance company, in turn, pays the owner a fixed stream of payments at some point in the future. Annuities are primarily used as an income stream for retirees. Due to the large premiums that had to be paid into the plan each year, a 412(I) plan was not ideal for all small business owners. The plan tended to benefit small businesses that were more established and profitable. For example, a startup that had gone through several rounds of funding would have been in a better position to create a 412(I) plan than one that was bootstrapped and/or had angel or seed funding. These companies also often don't generate enough free cash flow, FCF, to put away consistently for employees' retirement. Instead, the founding team members often reinvest any profits or outside funding back into their product or service to generate new sales and make updates to their core offerings. In August 2017, the Internal Revenue Service identified 412(I) plans as being involved in various types of noncompliance. These also included abusive tax avoidance transaction issues. To help organizations with 412(I) plans come into compliance, the IRS developed the following survey. They asked, a survey of 329 plans yielded the following. Due to the abuses of the 412 plan resulting in tax avoidance schemes, the Internal Revenue Service, IRS, moved the 412(I) provisions to 412(E)(3) effective for plans beginning after December 31, 2007. 412(E)(3) functions similarly to 412(I), except that it is exempt from the minimum funding rule. According to the IRS, the requirements for 412(E)(3) are as follows. Here are 4 key takeaways. 1. A 412(I) plan was a defined benefit pension plan that was designed for small business owners in the U.S. 2. A 412(I) was a tax-qualified benefit plan, meaning the owner's contributions to the plan became a tax deduction for the company. 3. Guaranteed annuities or a combination of annuities and life insurance were the only things that could fund the plan. 4. Due to tax avoidance schemes that were occurring under 412(I), the Internal Revenue Service, IRS, replaced it with 412(E)(3). Hope this would help. Thanks for watching.